Did you know that if you start investing at just 16, you could have over $1 million by the time you're 65? Sounds crazy, right? But it's not. The earlier you start, the more time your money has to grow, and the better your chances of becoming wealthy. Here's the shocking part. 9 out of 10 teenagers don't even think about investing. Most wait until they're older to start saving, missing out on years of growth. But the truth is, if you start now, you could easily beat the odds and be way ahead of the game. In this video, I'll show you how to use simple, proven strategies to start investing today. You don't need a lot of money, fancy tools, or years of experience. You just need to know the right steps to take. I'll teach you how to build your investment mindset, pick stocks, and make your money work for you, no matter your age. Ready to unlock the secret to growing your wealth? Let's dive in. Chapter 1. The Teenage Investor's Mindset. Why you're already ahead. If you're a teenager, you're already ahead of most adults when it comes to investing. Why? Because time is your greatest asset. The earlier you start, the more you can benefit from compound interest. Albert Einstein once said, "Compound interest is the eighth wonder of the world." That's no exaggeration. The earlier you invest, the longer your money has to grow, and that can make a huge difference by the time you reach adulthood. Here's a fun fact. If you start investing at age 16 and contribute $100 a month until you're 30, you could have over $100,000 by the time you retire, assuming an average return of 7% per year. Even if you stop contributing after you turn 30, that money continues to grow for decades. It's all about building momentum. But how do you get the right mindset to make this work? It's about being patient. A big part of investing is staying calm, even when the market feels like a roller coaster. Teenagers are often used to instant results from social media or gaming. Investing, however, is about slow, steady growth. Warren Buffett, one of the most successful investors of all time, once said, "The stock market is a device for transferring money from the impatient to the patient. Your job is to be patient." If you invest and hold onto your shares for years, you'll be setting yourself up for success. So start thinking long-term. Don't worry about small day-to-day price changes. Instead, focus on the overall growth over time. It's also important to start building healthy financial habits now. As a teenager, your financial habits will shape how you manage money as an adult. You're also lucky because investing has never been easier for young people. With apps like Robinhood, you can start investing with no fees and low minimum amounts. This means you don't need thousands of dollars to get started. Even investing $5 or $10 regularly can lead to big rewards over time. So, get started now and watch your money grow. In short, the most important thing to remember is this: your biggest advantage is your age. Time is on your side. Be patient, stay consistent, and you'll be amazed at how your money can grow. Chapter 2. The Secret Sauce. Understanding value investing. Without the jargon, value investing might sound complicated, but it's actually simple to understand. Imagine you're at a store and see a pair of sneakers you really like. The store is offering a discount, and the price seems too good to pass up. That's basically how value investing works. It's about finding stocks that are on sale, undervalued, but still solid companies. The key to value investing is looking for companies that are selling for less than their true worth. These companies may not be in the spotlight right now, but they have a solid foundation and a lot of potential to grow over time. Think of it like finding hidden gems in a thrift store. You don't always see the value at first, but if you dig a little deeper, you find something special. One of the best examples of value investing is Warren Buffett's approach. Buffett often looks for companies that have strong management, a good track record, and a low stock price relative to their earnings. That means you're not just buying a stock because it's cheap, you're buying a stock because it's undervalued and has long-term growth potential. A great way to spot a value stock is by looking at the price to earnings (P/E) ratio. The P/E ratio is simply the price of the stock divided by the company's earnings. The lower the P/E, the cheaper the stock. For example, if a company's stock price is $100 and it's earning $10 per share, its P/E ratio would be 10. That's a relatively low P/E ratio, which might signal a good value opportunity. However, you don't just want to buy any cheap stock. It's important to make sure the company is healthy. Look at its debt, management, and how it's performing compared to competitors. Value investing is about buying quality at a fair price, not just looking for the lowest price. A unique statistic. According to Morningstar, companies with low P/E ratios have outperformed the market by an average of 6% per year over the last 20 years. That's significant. By buying undervalued companies and holding onto them for the long run, you can make solid returns without taking on excessive risk. To make value investing work for you, take your time to research. Don't jump on a stock just because it looks cheap. Take a closer look at its financials, history, and growth potential. Being patient with value investing is crucial, but it's worth it. The goal isn't to make quick money, but to find companies that will continue to grow and thrive over the long term. Chapter 3. Teen-friendly stocks. The best investment opportunities for your age as a teenager. You probably have interests that are different from the average adult. Maybe you're into video games, fashion, or the latest tech gadgets. That's perfect because investing in things you're passionate about can actually be a smart strategy. By investing in companies you understand and use, you're more likely to make informed decisions. For example, let's talk about gaming. The video game industry is massive, with the global market expected to reach $200 billion by 2025. Companies like Activision Blizzard and Nintendo are key players. If you love gaming, you probably know these brands well. That gives you an edge when deciding whether their stock prices are fair or undervalued. Another area to explore is technology. Teenagers are some of the earliest adopters of new gadgets. Companies like Apple or Tesla often have products that appeal directly to younger generations. When you understand what's popular and why it works, you can make better decisions about which stocks to buy. Plus, many of these companies have a history of growth and innovation. Sustainability is another great sector to consider. Millennials and Gen Z care about the environment, and so do many companies today. Brands like Tesla or Beyond Meat are creating eco-friendly products that align with these values. These companies are not only leading in sustainability, but they're also seeing increased demand from consumers who care about the planet. According to recent research, millennials and Gen Z are driving the demand for green investments. In fact, 72% of millennials say they would invest in companies that promote sustainability. So, if you want to make an impact with your investments, consider companies with eco-friendly missions. Finally, let's talk about the importance of diversification. As a teenager, you don't need to put all your money in one company or sector. Diversifying means spreading your money across different stocks, industries, and even asset types. This helps reduce risk and increase the potential for long-term growth. Consider mixing some stable, reliable stocks with a few growth stocks to balance out your portfolio. If you're enjoying this content and want more tips on smart investing for teens, make sure to hit that subscribe button and turn on the bell for notifications. Chapter 4. The Power of Small. Why small amounts can make you big money. One of the best things about investing as a teenager is that you don't need a lot of money to get started. In fact, even small amounts can grow into something big if you stick with it. The key is consistency. If you can commit to investing even just $10 or $20 each month, you could end up with a lot more than you expect when you're older. Take the example of a teenager who starts investing $100 a month at age 16. Assuming a modest annual return of 7%, by the time they're 65, they could have over $350,000. That's because of the magic of compound interest, the ability of your money to earn interest on itself. The earlier you start, the more time your money has to grow. But how can you start small and still see results? The trick is to choose investments that have the potential to grow over time. Instead of trying to pick individual stocks, which can be risky, think about investing in index funds or ETFs. These are collections of stocks that track the market or specific sectors. They allow you to invest in a broad range of companies, helping spread out risk. Index funds are known for being a reliable way to grow wealth over time. For example, the S&P 500 index has historically returned about 7% annually, even after inflation. That means, even if you're only able to invest small amounts, you can still make good returns. One of the best ways to start small is through apps like Acorns or Robinhood. With Acorns, you can round up your daily purchases and invest the spare change into a diversified portfolio. These apps make it easy for anyone, no matter their budget, to get started in the market. Another great way to invest small amounts is by using fractional shares. This allows you to buy a portion of a share rather than the entire stock. So, if you want to invest in a company like Amazon, but the stock costs $3,000 per share, you can still buy a fraction of it for as little as $1. It's an easy way to get exposure to expensive stocks without breaking the bank. In short, you don't need a lot of money to start investing, just a willingness to make small, consistent contributions. Over time, those small amounts can add up and help you build a sizable portfolio for the future. Chapter 5. Risk-free investing. How to safeguard your teenage portfolio. When it comes to investing, there's always some risk involved. But as a teenager, you have an advantage: time. The longer you have before needing your money, the more you can afford to ride out the ups and downs of the market. But that doesn't mean you should take unnecessary risks. One strategy to reduce risk is to invest in diversified funds like ETFs and index funds. These funds are made up of many different stocks, so you're not putting all your money into one company. By spreading your money across various industries, you lower your risk significantly. This way, even if one stock doesn't do well, others in your portfolio might perform better. The key to successful investing is understanding your risk tolerance. Some people like taking bigger risks for bigger rewards, while others prefer to keep things safe. As a teenager, you have the luxury of taking on more risk, but it's important to find a balance. Too much risk could cause you to lose money, but too little risk may not generate enough returns. Don't forget to subscribe for more tips on how to manage risks while investing and growing your wealth. Chapter 6. From Teen to Tycoon. How to stay on track and keep growing your money. Investing is a long journey, and as a teenager, you have a head start. But the most important part of this journey is staying on track. How can you keep growing your money over time? It starts with setting goals and sticking to a plan. The first step is to make sure you're consistently investing. Setting up an automatic transfer to your investment account every month can help you stay disciplined. Even if it's just $10 a month, getting into the habit of regularly contributing to your investments will pay off in the long run. As you grow older and earn more money, you'll have the opportunity to increase your contributions. Aim to gradually raise your monthly investment amounts. The more you can invest, the more your money will grow. Next, always keep learning. The world of investing is always changing, so it's important to stay informed. Read books, listen to podcasts, or follow financial blogs to keep up with the latest news and strategies. One of the best books to get started with is The Intelligent Investor by Benjamin Graham, which teaches the fundamentals of value investing. The more you learn, the better equipped you'll be to make smart investment decisions. Thanks for watching. Don't forget to subscribe to the channel so you can keep up with all the latest tips and tricks to grow your wealth and become a smart investor.